30%. That number is the single most important signal in the entire precious metals market right now, and almost nobody outside of professional mining analysts is talking about it. 30% above market price. That is what Hecla Mining, the largest primary silver producer in the United States, was willing to pay for silver assets when the current spot price was already sitting at levels that multiple independent analysts have confirmed as the definitive price floor for this cycle. When the dominant player in the domestic silver mining industry pays a 30% premium to acquire silver resources, they are not making a routine business decision. They are telling you through the only language that is genuinely honest in finance, the language of capital allocation, that silver at today's prices is not just cheap. It is so fundamentally undervalued that waiting even 6 to 12 months means paying dramatically more. Meanwhile, APMEX, the largest online retailer of physical precious metals in the United States, serving millions of customers in every state across the country, just cleared through a period of severe silver shortage. The shelves that had been stacked with 1-ounce coins and 100-ounce bars were wiped out as demand from retail buyers overwhelmed their supply chain. This was not a brief blip. This was a sustained run on physical silver by ordinary Americans who understand something that mainstream financial media refuses to report honestly. The price printed on a screen is not the real price of silver. The real price is what you actually pay to hold physical metal in your hands. And the gap between those two numbers is now wider than it has been in years. Together, these two facts form a pattern that has appeared before every major silver price explosion in modern financial history. The institution that knows the most about the underlying commodity is aggressively acquiring it at a premium. The retail buyer who actually wants physical delivery is running into empty shelves. The paper price is disconnected from physical reality, and most investors are completely unaware that any of this is happening. They are watching the paper ticker and missing the actual story happening in the physical market underneath. Before we break down exactly what is driving this disconnection, why the price floor confirmation changes everything about the risk-reward calculation for silver, and what the Hecla move signals about where prices are headed, make sure you are subscribed to this channel and have turned on the notification bell. We track the precious metals market and the institutional moves behind it in real time. When the next critical signal fires, you will be the first to know. Comment below right now with gold or silver to tell us which physical asset you are holding as your financial insurance. We want to see exactly where our audience stands heading into what may be one of the most important periods in precious metals history. To understand why the Hecla premium is not just significant, but potentially historic, you need to understand what Hecla Mining actually is and what it actually does. Hecla Mining is not a junior mining explorer or a speculative startup looking for its first discovery. It is a company that has been producing silver in the United States for over 130 years. Their operations include the Greens Creek Mine in Alaska, one of the largest silver mines in the world, and the Lucky Friday Mine in Idaho, one of the most productive silver operations in American history. When Hecla makes an acquisition decision, it is backed by 130 years of geological experience, processing expertise, and a deep operational understanding of the true cost to bring silver out of the ground and deliver it to market. They know, more precisely than almost any other entity on Earth, what silver is actually worth at the mine level. They know the production costs, the processing costs, the labor costs, the regulatory compliance costs, the capital expenditure requirements for maintaining aging infrastructure. They know the difference between a geological deposit that looks good on a map and one that can actually be mined profitably at scale. And when they look at the current spot price and decide that paying 30% above it for silver assets is a rational economic decision, that conclusion is not based on speculation or market sentiment. It is based on more hard operational data about the silver industry than any financial analyst writing about silver from a desk in New York or London has ever seen. Their willingness to pay 30% above the current market price is a direct statement that the current market price dramatically understates the underlying value of silver in the ground. This is not a prediction. It is a transaction. Real money changing hands at a 30% premium based on the calculated conviction that current prices will be seen as extraordinarily cheap in the very near future. In finance, when the insiders are buying aggressively, you pay attention. When the insiders are buying at a 30% premium, you ask yourself a single question. What do they know that you do not? What they know begins with the price floor confirmation that has now been validated by multiple independent technical and fundamental analyses. For the past several months, silver has been testing the same support level repeatedly, approaching it from above, bouncing back, consolidating, approaching it again, and bouncing back again. This pattern in technical analysis is called a tested and confirmed floor, and it has a specific and historically reliable implication. Every time the price tests a floor and fails to break through, the institutional buyers sitting at that level demonstrate both their presence and their conviction. Each failed test adds another layer of buying pressure beneath the price. The floor becomes structurally stronger with each successive test, because the buyers who defended it successfully the first time are still there, still defending it, and they have now been joined by additional buyers who watched the previous tests and concluded the floor was genuine and worth defending. The confirmation of a tested floor after a sustained price decline is not the beginning of a slow grind higher in price. Historically, across multiple commodity cycles and precious metal markets, this confirmation is the starting point for a violent and rapid upside move. The compression of price into a floor region, combined with sustained physical demand running faster than available supply, creates a coiled spring dynamic where energy builds silently for weeks or months before releasing all at once. The Hunt brothers' silver squeeze of 1980 sent silver from $6 to $50 in less than 12 months. The 2011 silver rally took the price from $8.50 to $49 in approximately 2.5 years, a 476% move driven by the same fundamental forces that are currently aligning in silver today. Physical demand surge, paper physical price disconnection, institutional recognition of deep undervaluation. The pattern is not new. The pattern is repeating. But the story does not stop at technical price analysis and historical parallels. The story gets significantly more complex and significantly more dangerous for anyone who is waiting on the sidelines when you examine what is actually driving the demand for physical silver at the retail level. Because the APMEX shortage is not a random inventory management problem. It is a symptom of a structural shift in how ordinary Americans are thinking about financial risk and the reliability of paper-based wealth. APMEX processes hundreds of millions of dollars in precious metals transactions every single year. They have sophisticated supply chain relationships with the major mints, including the United States Mint, the Royal Canadian Mint, and the Perth Mint in Australia. They have institutional knowledge of demand cycles across multiple economic environments, including the 2008 financial crisis, the 2011 silver price peak when physical silver was nearly impossible to source at any price, and the 2020 pandemic response when another massive shortage developed. When APMEX runs short on physical silver, it is not because they failed to plan their inventory. It is because the scale of retail demand has exceeded every historical precedent in their inventory and forecasting models. When the biggest dealer in the country cannot keep silver on the shelf, you are not looking at a temporary supply disruption caused by a logistics problem. You are looking at a structural mismatch between what the paper futures market says silver is worth and what actual human beings are willing to pay to own physical silver right now. The gap between the paper price and the physical premium is one of the most important and most deliberately ignored signals in the precious metals market. When you attempt to buy 1-ounce silver American Eagle coins from any major dealer in the current environment, you do not pay the spot price. You pay the spot price plus a significant premium, typically ranging from $3 to $8 per ounce depending on availability and demand conditions. That premium represents the real market clearing price for physical silver. The spot price is determined by the futures market where contracts for silver delivery are traded in volumes that are entirely disconnected from the physical supply available. What makes this gap dangerous is not its existence. The gap has existed for decades. What makes it dangerous is its direction of movement. When the premium between paper price and physical price widens, it means that the people who actually want to hold real silver, not a computer entry in a brokerage account, are willing to pay progressively more to get it. And that premium expansion is the early warning signal that the paper price will eventually be forced to converge with physical reality. This is the mechanism that is not discussed on CNBC. This is the data that is not in any mainstream financial report. This is what they are not telling you. The paper silver market, the futures and options complex that generates the spot price quoted globally, trades an estimated volume of paper silver claims every single trading day that is between 200 and 250 times the amount of physical silver that actually exists in registered depositories for delivery. For every 1 ounce of real, physical, deliverable silver that could theoretically be extracted from the system in exchange for a futures contract, there are between 200 and 250 outstanding paper claims on that same ounce. The entire architecture of paper silver pricing is a structure built on leverage, not on physical substance. This system functions as long as most paper silver holders never demand physical delivery. It functions as long as the overwhelming majority of futures contract holders are purely financial participants, speculators and hedgers who roll their positions forward every month and have no intention of ever touching real silver. The moment that demand for physical delivery rises significantly, the leverage ratio becomes a crisis. The moment that entities holding paper claims decide they want actual metal in their hands rather than a computer entry, the paper price must rise dramatically to ration the inadequate physical supply. This is not a theory. This is arithmetic. 250 paper claims on 1 physical ounce cannot all be satisfied. The question is only which paper claim holders get physical delivery and which ones get cash settlement at whatever price is necessary to make them go away. The APMEX shortage is the retail-level manifestation of exactly this dynamic. Ordinary buyers want physical delivery. There is not enough physical silver to satisfy that demand at current paper prices. Premiums rise, shelves go empty. The paper price eventually follows. But the real danger lies 1 layer deeper than the silver-specific supply and demand dynamics. Because the forces driving the demand for physical silver in 2026 are not silver-specific at all. They are systemic, they are structural, and they represent the most significant realignment of the global financial architecture in more than 50 years. America's banks are currently carrying $337 billion in unrealized losses on their securities portfolios. $337 billion of losses that exist on the books, but have not been forced into recognition because the banks have not been compelled to sell the underlying securities. Silicon Valley Bank was carrying $17 billion in unrealized losses when it failed in 2023, triggering a regional banking panic that required an emergency backstop from the Federal Reserve, the Treasury, and the FDIC working in coordination over a single weekend to prevent a broader systemic collapse. The entire United States banking system is now carrying 20 times the unrealized losses that brought down Silicon Valley Bank. The mechanism that destroyed SVB is sitting inside hundreds of regional banks across America right now, scaled up by a factor of 20, and the FDIC Deposit Insurance Fund holds $129 billion to protect all insured deposits in the entire American banking system against this exact scenario. The math of those two numbers is not reassuring. The commercial real estate crisis is compounding this pressure. $1.5 trillion in commercial real estate mortgages are reaching their maturity dates in 2026, requiring refinancing at interest rates that are more than double what they were when the original loans were written. Office values in major American cities have fallen 35 to 50% from their 2020 peaks. A building purchased for $100 million in 2020 with a $70 million mortgage now has a market value of $55 million and a debt obligation of $65 million. The loan is larger than the asset. The bank holding that loan is carrying a loss that does not appear in the official reports because the property has not yet been sold at the distressed price. But the loss is real. It exists. And when it is eventually recognized, either through a sale, a refinancing that cannot be completed, or a bankruptcy filing by the property owner, it will flow directly onto the bank's balance sheet as a realized loss. Regional and community banks hold approximately 70% of all commercial real estate loans in the United States. The first bank failure of 2026 has already occurred. Metropolitan Capital Bank and Trust in Chicago was seized by Illinois regulators in January and placed in FDIC receivership. The cause was tied directly to a troubled commercial real estate loan. This is not an isolated incident. This is the first domino in a sequence that has $57 billion of commercial mortgage-backed securities already identified as being in default risk territory right now. Each domino that falls applies pressure to the next. Each regional bank failure tightens credit conditions for the businesses and households in that community. Each tightening of credit slows economic activity. Each slowdown in economic activity produces more loan delinquencies, which produces more bank stress. The cycle feeds itself. This is the context in which people are buying silver. They are not buying it because they expect the price of silver to rise modestly over the next several years. They are buying it because they understand that the paper-based financial system is carrying risks that are visible to anyone willing to read the data, and that physical silver in their possession is an asset that cannot be frozen, cannot be bailed in, and cannot lose value because a bank's bond portfolio declined. They are buying the financial insurance that has been recognized as such for 5,000 years, and they are buying it at a price that Hecla Mining, the entity that knows silver better than anyone else on Earth, has told you through its own capital expenditure decisions is dramatically below fair value. Your retirement account is exposed to a 20 to 30% equity market correction that the chief executive officer of JP Chase, the largest bank in the United States, has stated publicly is a higher probability than markets are currently pricing. Your bank deposits may be sitting in an institution that is carrying unrealized losses large enough to threaten its capital base. Your bonds are caught between a Federal Reserve that is paralyzed by tariff-driven inflation and a market that is demanding ever higher yields to absorb the United States government's $2 trillion annual deficit. Every dollar you hold in paper form is a claim on a financial system that is under structural stress from multiple directions simultaneously. Silver, the metal that has been used as money across virtually every major civilization in human history, has no counterparty. It has no management team that can make a bad acquisition. It has no bond portfolio that can develop unrealized losses. It has no regulator that can freeze it. It exists. It is real. And it is currently priced below what the insiders who know it best are willing to pay for it. The Dodd-Frank Act signed into law in 2010 contains provisions that most depositors have never read, and that most financial advisors will never discuss with you because the conversation is too uncomfortable. Under the bail-in framework established by Dodd-Frank, in the event of a systemically important financial institution approaching insolvency, certain categories of unsecured bank liabilities can be converted to equity in the failing institution as a mechanism to recapitalize it without an immediate taxpayer bailout. Your bank deposit above the FDIC insurance threshold of $250,000 per depositor per institution is legally classified as an unsecured loan to your bank. In a bail-in scenario, your uninsured deposit does not get paid back. It gets converted into equity, typically worthless equity, in an institution that is in the process of failing. This is not a hypothetical future legal framework. It is current law. It was written specifically to eliminate the political requirement for taxpayer bailouts by making depositors the source of bank recapitalization. The window to protect yourself from this legal reality is open right now. It will close when the crisis generates headlines. The FDIC Insurance Fund holds $129 billion. The total value of bank deposits in the American banking system is measured in the tens of trillions of dollars. If the commercial real estate losses and the unrealized securities losses in the regional banking sector materialize simultaneously, the arithmetic of FDIC coverage becomes obvious. They cannot make everyone whole. They will make depositors at smaller institutions whole while prioritizing the containment of panic at the largest, systemically important banks. This is not speculation about what might happen. This is the operational logic of the FDIC's resolution framework. They will manage the sequence of failures to prevent systemic panic, but they cannot prevent the losses themselves. The losses already exist. They are just not yet recognized. So what do you do with this information? There are 5 concrete steps that protect your financial future without requiring you to make dramatic changes based on a specific timeline for when the crisis becomes visible. Step 1. Allocate a meaningful percentage of your liquid savings into physical silver this week. Not a silver ETF, not a mining fund, not a futures contract. Physical silver in your possession. 1-ounce coins from government mints, 10-ounce bars from recognized refiners, or junk silver bags of pre-1965 United States circulated coins, which trade at a discount to new bullion products and represent excellent value. Physical silver in your possession has no counterparty risk. It cannot be subject to a bail-in. It cannot be frozen by a bank. It cannot generate unrealized losses. It cannot lose value because a regulator changes the rules. Contact APMEX, JM Bullion, or SD Bullion today. Do not wait for the next shortage to return before you act. Step 2. Examine your banking relationships with the understanding of what you now know about bail-in law and FDIC insurance limitations. Do not hold more than the federally insured limit in any single institution. Prioritize spreading liquid funds across multiple accounts at systemically important institutions that the federal government has the strongest implicit mandate to protect. A 15-minute review of your banking relationships could be the most financially protective action you take this year. Step 3. Review the commercial real estate exposure of any regional bank where you hold significant deposits. Most banks are required to disclose their loan concentrations in their quarterly regulatory filings. A bank with more than 300% of its Tier 1 capital concentrated in commercial real estate loans is in a different risk category than a bank with diversified loan exposures. This information is public. It is available on the FDIC website. Most people will never look at it. You now know to look. Step 4. Move a meaningful portion of your liquid savings into short-term United States Treasury bills through Treasury Direct at treasurydirect.gov. Treasury bills are direct obligations of the United States government, completely outside the banking system, and are currently yielding above 4% annually. In a scenario where regional banks face solvency pressures, Treasury bills are the most liquid and safest cash equivalent available to retail investors without going through the banking system at all. Step 5. Stop waiting for official confirmation that a crisis has begun. Official confirmation is always the last signal to arrive. The first signals arrive in the form of data, institutional behavior, and physical market dynamics. The data on unrealized bank losses has been published by the FDIC and the Office of Financial Research. The institutional behavior is visible in Hecla Mining's 30% premium acquisition. The physical market dynamics are visible in the APMEX shortage. All of the signals are present. All of the evidence is in front of you. The only question that remains is whether you are the kind of person who acts on evidence before the crowd arrives, or whether you wait for the mainstream narrative to validate what you already know by the time it is too late to act. Warren Buffett said that price is what you pay and value is what you get. The price of silver today, as printed in the paper futures market, is not the value of silver today. The value of silver today is confirmed by every actor in the market who understands it deeply enough to put their own capital at risk. It is confirmed by Hecla Mining paying 30% above the paper price. It is confirmed by APMEX's inability to keep physical silver on the shelf at any normal premium. It is confirmed by the central banks of Russia, China, Poland, India, and dozens of other nations buying gold, silver's monetary twin, at the fastest pace recorded in modern history. It is confirmed by the structural convergence of dollar displacement, banking system fragility, industrial demand growth from the global energy transition, and paper physical price disconnection that are all pointing in the same direction simultaneously. The smart money does not announce what it is doing. It acts. It has already acted. Hecla Mining has already paid its 30% premium. APMEX has already experienced its shortage. The institutional buying behind the price floor confirmation has already occurred. What has not yet happened is the move in the paper price that reflects all of this activity. That move is coming. The only question is whether you are positioned to benefit from it or whether you are among the people who will read about it after the fact and wonder why nobody told them. Subscribe to this channel and turn on the notification bell. Every major institutional move in the precious metals market, every critical development in the physical supply chain, and every signal in the global dollar displacement story will be covered here the moment it becomes visible. Share this video with anyone you know who is holding significant savings in paper-based instruments and has not yet thought seriously about physical precious metals as financial insurance. They may not want to hear what the data says, but the data does not care whether people want to hear it. The data simply reflects reality. And the reality is that silver, right now, is one of the most asymmetric opportunities in the financial world, undervalued by its own industry insiders, undersupplied at the physical level, and positioned at the exact intersection of monetary history, industrial necessity, and systemic financial risk. Together, we can navigate this financial transition and emerge with our wealth and our purchasing power intact. The information is here, the data is here, the evidence is in front of you. Stay liquid, stay skeptical, stay ahead.